To be clear, our analysis is not a projection. It's an assessment of vulnerabilities, pockets of existing or potential stress that could spread across the financial system. So let me now turn to the Senior Deputy Governor to outline these vulnerabilities and how they affect the four key sectors of our financial system: households, businesses, bank financial intermediaries. This is a broad category including finance companies, pension funds, insurance companies, and fund managers. Carolyn.
Thank you, Governor. I'll start with households. Total debt relative to disposable income is lower than it was a year ago, but still high by historical standards. Despite lower interest rates, signs of financial stress have risen over the past 12 months, particularly in households without a mortgage. For example, the share of these households that are behind on credit card or auto loan payments has continued to go up. Among households with a mortgage, about 60% are facing renewal this year or next. Most of those renewing will see their payments rise because they took out their mortgage during the pandemic when rates were at historic lows. But the average increase in payment will be smaller than we expected a year ago. Still, if a large shock causes job losses, it'll be harder for some households to keep up with their debt payments. A prolonged trade war may be that shock. It would cause demand for Canadian exports to fall. It would disrupt supply chains, threatening jobs and incomes. Workers in trade-dependent industries could find it particularly difficult to continue managing their debt. A prolonged trade war would also matter for businesses. Most Canadian businesses have managed to adjust to past interest rate increases, and the surge in small business insolvencies last year proved to be temporary. But businesses in trade-related sectors, especially those with high debt, low profitability, or cash reserves, could also fall behind on debt payments. A strength in our financial system is that Canadian banks are well positioned to absorb higher credit losses. Banks have increased their capital buffers in recent years, and more recently they've also increased their provisions for credit losses, and these both bolster their resilience. Liquidity levels remain high, and access to funding for banks is also good. But if credit losses occur on a large enough scale, banks could cut back on lending in response. Struggling households and businesses would then have less access to credit to get through tough times. This cycle could exacerbate the economic downturn. In the non-bank financial sector, the growing presence of hedge funds in the market for Government of Canada bonds raises some concerns. Government bond markets are the foundation of the financial system, and they need to function smoothly for all other markets to work well. The increased activity by hedge funds has helped absorb increased issuance of government debt, keeping yields lower and liquidity higher. But hedge funds have also taken on increasingly large amounts of leverage to fund their purchase of government bonds. And this makes them more likely to pull back from these crucial markets in periods of stress, introducing added volatility. The recent gyrations in the U.S. Treasury market clearly illustrated this risk. If the trade war causes a larger spike in volatility than we've seen so far, leveraged hedge funds might rush to sell their holdings. That could strain liquidity across core markets, increasing stress throughout the financial system. Moreover, the growing connection between banks and non-bank financial institutions could make it easier for stress to spread. Against that backdrop of increased market volatility, and given their importance in the government bond markets, hedge funds need to make sure that they're prepared to respond to sudden liquidity needs without disrupting broader market functioning. It's time to wrap up. Notre système financier est solide. Malgré les dettes élevées et la pandémie, les Canadiens ont surmonté la hausse rapide des taux. C'était un test majeur.
The Canadian financial system is resilient, Despite high indebtedness and the economic turbulence of the pandemic, households, businesses, and banks weathered a rapid rise in interest rates. That was a big test, and the financial system proved to be a source of stability.
Despite high indebtedness and the economic turbulence of the pandemic, households, businesses, and banks weathered a rapid increase in interest rates. That was a big test, and the system proved to be a source of stability. But we must all remain vigilant. Vulnerabilities remain, and there is another test on the horizon. By identifying vulnerabilities, we can help the financial system prepare for future stress. We're watching developments closely and remain in regular contact with financial system participants and with other authorities in Canada and globally. A stable, resilient financial system that absorbs shocks rather than amplifying them benefits every Canadian. And with that, the Governor and I would be pleased to take your questions.
I know the tariffs move around and I know things change a lot, but in the current context that we find ourselves today with the tariffs that are on Canada, if they were to stay in place for an extended period of time, would that lead to the severe economic consequences that you referenced in the report?
You know, we're not here to give a forecast, but I mean, what I can say is that the current tariffs are significant, but the scenario 2 that we focus on in the FSR would be a significant escalation relative to where we are today, not only for Canada, but for other countries around the world. And that would imply a much bigger effect on the global economy. Canada's an open economy. We trade with the global economy. If the global economy slows sharply, that will spill back into Canada. And they're also more serious for Canada. So scenario 2, I mean, the current situation is problematic really for 2 reasons. 1, the tariffs themselves. 2, the uncertainty. Where are we going from here? And it's very hard for businesses to plan their investment decisions, their hiring decisions, if they don't know the path forward. So, it is already having a material effect on the economy, but scenario 2 would be a lot worse than where we are now.
On that, you just mentioned it there, that the uncertainty and even the specter of tariffs hanging over the Canadian economy impacted investment. If the tariffs ended tomorrow, would there be significant scarring in the Canadian economy that would last going forward? And on that point as well, in the report you mentioned prolonged trade war going forward. Can you just put a timeline on what you estimate prolonged would need to be for these impacts to happen?
Well, look, on the second one, I mean, these are illustrative scenarios. I mean, prolonged means, it's not a year, it's not, it's at least a few years. So I'm not going to put a precise number on it, but it's several years. With respect to your first question, if the tariffs are removed, sorry.
Just the impact, you kind of mentioned in the previous answer, just how much, if the tariffs ended tomorrow.
Oh, how much scarring will there be?
The scarring.
That's a very good question. I expect there will be some permanent impacts. It does feel like trust has been broken to a certain degree. And, to be frank, there's some things Canada should have been doing anyways. We should have been developing broader markets than the U.S. We should have been strengthening our internal connectivity, internal trade, internal transportation. I do think there will be some permanent effects because I think, to some degree, trust has been broken to some degree, and we're not going to get that all back right away.
Finally in the room, Paul Vieira from Wall Street Journal.
Better take that.
Good morning. Outside of moral suasion, what tools are available to persuade hedge funds to heed your message on liquidity?
I mean, one of the primary tools is the report itself and bringing some transparency to the risks that we see. We talk to hedge funds and other asset managers on a frequent basis. This isn't the only time we're talking to them about their risk strategies and stuff. So, I mean, one of the benefits of the Financial Stability Report is we help other sectors of the financial sector understand what where the vulnerabilities are as we see them, and what the contingency planning is. Because what you don't want to have happen is whatever risk strategy one sector has to manage volatility depends on another sector doing something or not doing something, and it turns out we're all storming for the doors at the same time. We're all looking for liquidity at the same time. So just bringing the transparency to the vulnerabilities, helping each sector understand what the other sector is doing and what their risk strategies are, is a tool in and of itself. We're not a regulatory body. We work closely with other regulatory bodies across both domestically and internationally. But it's not necessarily our role to bring regulation, and quite honestly, not every problem requires regulation to fix it. Sometimes the transparency is enough.
Okay, all good there. That's it for Ottawa. We're going to go to the reporters who have joined remotely. I'll just remind you folks on the line, please come off mute only to ask a question, then go back on mute as soon as you finish. That way everyone can hear the response. And I'm going to start with Ian Bickus from Canadian Press. Please go ahead, Ian.
Thanks for squeezing in my questions. We did just have an election in Canada, and I know you don't want to weigh on what the government should do, but can you say kind of what areas of policy or government action you'll be most closely watching that might affect financial stability going forward?
Well, it's a pretty wide open question. I mean, regulation, so the oversight of the financial system, or at least the banking system, the federally regulated banks, is provided by the Office of the Superintendent of Financial Institutions. We've got the CDIC, the Deposit Insurance Corporation, which protects depositors. You've got FCAC, the consumer agency that protects consumers. The banks, and then you've got the finance department, the government, that creates the legislative framework that everybody operates in. So we do work together. The bank's role is very much assessing the vulnerabilities and using our expertise from a kind of a macro financial perspective. We're not focused on individual entities the way the Office of the Superintendent of Financial Institutions would be. We're really looking at the system as a whole, the interactions, and how one vulnerability could spill over to others. So, this new government is just getting formed. The cabinet hasn't even been named. Let's see what their priorities are for the financial system.
Maybe one thing I'll maybe elaborate on a bit. The bank does have quite a new mandate to regulate the payment space. And one thing we are hearing in the U.S. right now is a desire to increase the role that cryptocurrencies play in the financial sector. So right now, both in the U.S. and in Canada, cryptocurrencies are largely, they're regulated as a security. They're really used to sort of speculate. If cryptocurrencies become a form of payment, then consumers will need to rely on them, on their value remaining stable. So there's lots of discussion about stable coins becoming a more common payment form. If that happens, certainly we would have we would need to introduce new legislation in Canada to ensure that we have the proper protections in place to use cryptocurrencies as a form of payment, or stable coins as a form of payment.
Thank you. And then just following up, you do mention the report that the renewal risk for mortgages has come down, or the pressure has come down. How much does that reduce the need to kind of reduce rates, or how much is that going to affect your decision on rate decisions, the kind of mortgage renewal pressures that have been a big concern in the past?
Well, I mean, we look at many things when we make rate decisions. We don't make them purely on the mortgage market. It is one of the things we always consider. Really, again, from a financial stability perspective, we were watching carefully. We knew that the interest rate response to inflation was putting pressure on on households, and particularly on mortgages. We've watched that carefully. As rates have come down and other things such as income have come up, that pressure has eased. But it doesn't. It's not. It's not a variable on which an interest rate decision turns.
Okay, let's go to Mark Rendell from the Globe and Mail, please.
Thanks for taking the question. Governor, you mentioned earlier in response to an earlier question, you're not trying to handicap whether we're heading towards scenario 1 or scenario 2. But there have been a number of developments since the rate decision and since the NPR, whether that is, hints from the U.S. that they're talking to China, a deal today with the U.K. apparently being announced, what seems like a pretty positive meeting between the Prime Minister and Mr. Trump. Are we closer to scenario 1 than scenario 2 than we were in the NPR? And how have those probabilities shifted since the NPR?
Well, Mark, where I'd start is this continues to be a moving target, and that's why we had scenarios, and I think until we have a clearer sense of direction, I think those scenarios are useful. Let's hope, particularly by the time we get to the July monetary policy report, there is a clearer sense of direction, and we can at least narrow the scenarios or possibly move more to a central scenario. But we're not there yet. Look, it's pretty, it continues to move around, and so I think you have to be careful about, getting too focused on exactly where you are, what scenario. I mean, I will give you this. Yes, since we did the last monetary policy report, since the April monetary policy report, there have been some positive developments. And yes, I think that, what we said is we're somewhere between 1 and 2. Yes, so we've moved a little closer to 1. But, it is still pretty early days. We're going to, yes, I have, the UK deal is about to get announced. There are potentially a whole other series of deals. Canada needs to sit down with the United States and chart a path forward. So I think we have to be prepared for the fact that let's hope we keep moving in the right direction, but we have to be prepared for the fact that some other things, there could be some setbacks, there could be some new volatility, and that's why we're having this discussion here today. We want to make sure that there is a level of vigilance, that there isn't overconfidence that everything is going to work out, and that the financial system is prepared for turbulence. Let's hope it doesn't happen, but let's make sure we're prepared if it does.
On the question of turbulence, I'm wondering, when you guys looked at the period in early April after Liberation Day, when there was a big sell-off in the Treasury market in US dollars, I'm wondering, can you guys explore when you were looking behind the curtain into different aspects of the financial system we can't necessarily see, what was principally happening? And you also, kind of continuation of that, you also highlight in the report, the risk that the kind of safe haven status of the U.S. assets and the U.S. dollar may be shifting over time. I'm wondering how big of a risk is that? Is that a tail risk? Is that something that you're taking more seriously now? Thanks.
Okay, well, for a follow-up, you packed a lot in there, Mark. But let me highlight a couple of things. First of all, it is important to distinguish between extreme volatility and market dysfunction. And we did see bouts of extreme volatility following the April 2nd announcement. But markets continued to function. We did not see dysfunction. Yes, liquidity was scarcer, it was more expensive, but if you paid up for it, it was there. Buyers were coming in. Markets continued to function. Second point, as you indicated, we did see some unusual correlations at these moments of extreme market volatility. In particular, equities and bonds both fell at the same time, and the U.S. dollar depreciated against a background of a broader flight to safety. So, yes, there has been considerable discussion around, okay, what was going on in the market at that time. And, there is a certain, particularly in the private finance part of the market, there is some degree of opacity. So it's hard to be definitive. And in fact, this has been one of the priorities the FSB, the Financial Stability Board, has globally, is to try to get more transparency into private finance. But certainly what it looks like is that hedge funds, which, as I mentioned, have been taking a bigger presence in U.S. Treasury market as well as Government of Canada market. They are leveraged, and it does appear that they were exiting some positions, getting cash. So that created additional selling at that point, and that put downward pressure on prices. So that did create a period of unusual correlations. Since then, market volatility has gone down. The correlations are back to more normal types of correlations. With respect to this issue of the U.S. dollar as the global reserve currency, yes, the performance of the U.S. dollar in moments of volatility is one part of its role as the global reserve currency, but there are many other dimensions, many other reasons why the U.S. dollar is the global reserve currency. And I think what you're hearing when you talk to global investors was, okay, well, even if the U.S. dollar is performing a little differently, if I'm not in U.S. dollars, I got to be in something else, and that could perform even more differently. So, we've seen a lot of money come into the United States in the last number of years. We may see some diversification out of the U.S. dollar. I don't think that would be too surprising, but that's very different from the U.S. dollar losing its status as global reserve currency, and I think it's way too early to speculate on that.
Okay, and that concludes today's press conference.